All right, welcome to our September Tech Brew. I'm very happy to have my brother, Henry Schwartz, as our presenter tonight. And Henry's going to share a little bit about Fintech and what he's doing now, what he did previously. I actually interviewed Henry back in 2008 when I interviewed 50 entrepreneurs for my book 50 interviews. So it was good to go back and look at that interview. He sold his company, or he got acquired in 2020. So we'll talk a little bit about that. But I've got some questions, but certainly if you guys have questions, feel free to ask him. I've asked him to kind of share a little bit about his business evolution of kind of where he came about, and then share a little bit about how technology is being used to drive the markets, because it's kind of been crazy. And I've realized that technology is probably the driver behind all that. So Henry, if you want to say anything else about yourself, take it away.
Well, thanks, Brian, and hello, everybody. And it's nice to do a little presentation for basically primarily a California group, because it is where I'm from. I've been in New York for 30 years or so now. I've kind of taken a deck that I prepared for an industry conference and taken a few things off. And we'll kind of I'll run through that, and then I'll show you really what I built. And I don't want to bore you with options industry stuff, but this is what I've done for the last 30 years or so. I started on a trading floor in Chicago right after college, primarily because it was either, I think the other offer I had was to be an actuary, which sounded so boring. I don't think I could have survived it. This is a picture probably from the 80s or 90s of a trading floor. When I started, this is where I worked. All those pieces of paper on the floor are these trading tickets that you can see on the right. And there was technology, I guess. But I mean, trades were written up by hand. Two people agreed on something with hand signals, kind of like maybe you see in the movies. And that was kind of my foundation. This one actually is the American Stock Exchange, which is where I worked for a few years. This is me right here. This is where the specialist stands, but in general, it's a trading crowd. Everybody's yelling at each other, trying to agree on what you're buying and selling. And options has been my specialty, kind of for my entire career, although stock and futures, it's kind of all related. And this was my little badge that I was wearing, probably in this picture, because I only had one. I'll try to make sure that I focus on how technology affects things. This is, I don't know if you guys have ever traded a listed option. We're talking about calls and puts. They've only been around since 1973. There were 4 exchanges for basically the first 25 years. So the CBOE, the P-Coast in San Francisco, the Philly, and the Amex pretty much had a monopoly. In fact, it wasn't even a monopoly. They kind of split things. So if you want to trade IBM options, your order would go to the CBOE. If you wanted to trade Microsoft, it would go to the P-Coast. You can see this kind of explosion in activity, and this is volume. So basically, this is just total annual option volume. And around 2000, it really kind of comes out of this funk and goes somewhat exponential. Pretty much from 2000 until 2010. What was happening there is automation was really finally taking hold in the options markets. So this little chart here, I like to stick as much as possible in charts, which I think breaks all sorts of rules. But basically, you went from these 4 exchanges that shared the entire market for the first 25 years to new exchanges showing up. And in fact, this one in 2000, right when volume basically has doubled over a couple of years. Also, the .com boom is taking place at the same time. There's a lot happening. This is exchange number 5, and then 6 and 7 and 8. Up until you have 16 exchanges, that's kind of where we are today. And you see that the annual volume basically went from 300 million contracts to about 4 billion contracts. And this year we're going to hit 9 billion contracts. And this, we will kind of focus on what the hell's going on in the last couple of years, because it's kind of astounding. But this is the market, and this is kind of what technology's done to it. This is what our market structure looks like. These are the 16 exchanges. They're run by 5 main groups. I work for CBOE. They're the ones that bought us, and they got me in the package. But there's 4 others. NASDAQ owns a whole bunch. ICE is the owner of the New York Stock Exchange and the American Stock Exchange. They have 2 options exchanges. Basically just a nice dynamic market that every exchange kind of has a pretty decent market share. Kind of zooming in on recent history, this average daily option volume, I just want you to understand that it's exploded, from, this is on a daily basis now. So, we had kind of a decade, this is a lot of volume, 8 million, 10 million contracts a day, but now we're running at 28 million just among single stocks, 11 million just among ETF options, and around 2 million contracts a day in the index world. That's SPX and VIX, which are the kind of the big institutional hedges. Still on the topic of technology, how this plays in is, so the first 4 exchanges were physical floors, and they still are. They still exist. There's still trading floors with guys on it. The other 12 exchanges, purely electronic computer matching engines where orders meet each other. You can see the market share of floor activity, and this only goes back to 2016. So basically all 16 exchanges are around. The floor market share, so the percentage of activity that traded on a floor, was kind of in the 20% range. This is COVID. So what happened here is the floors actually closed for about 6 weeks in March of last year. So the floor volume went to 0, the floor market share went to 0. But check this out. We've been reopened now for a year, and the floor volume isn't coming back. It's pretty much kind of stuck around the under 10%, which shows you that electronic execution, it's more efficient, it's faster, there's no errors, and you're finally, the floors may stick around because there's certain types of orders that work better on the floor, but in general, this boom in activity has been electronic, and we'll get to that. Volatility, we could talk about this for an hour. In general, options are valued. Okay, the prices people pay for options directly can correspond to how volatile, how crazy the market is. And the more crazy a market is, the more the options cost. And I think Brian's agenda included a little bit on ways to make money. I'm going to avoid that because I'll get yelled at if I talk about ways to make money. However, options, you'll notice that you can kind of think of this as a general price level for options, right? So with volatility around 20% or 15%, options kind of have a certain price to them. When volatility explodes up to 80%, options are effectively worth 10 times as much as they are down here. And volatility is a mean reverting behavior, right? The market gets scared and gets crazy for a period of time, whether bad things are going on or it's a panic or whatever. And then it kind of comes back to kind of where it's been. So, in a way, it's kind of like, some people, an analogy for an option is, there's 2 ways to look at it. You can either go with, the official explanation is it's a risk transfer asset that lets people adjust the profile of their portfolio. Other people would say it's a gambling chip, basically. And in fact, when I started my job, Brian, you probably don't know this. My dad was like, "You sure you want to go work in derivatives? It's just gambling." You can think of it that way, although it's gambling that serves a purpose. But the point here is that there are times when you have a panic or a really bad situation, people are forced to pay up for options, whether you think you kind of think of it as people buying insurance when their house is already on fire. You're going to pay a crazy price for that. And it kind of happens in the options world as well. It's usually an opportunity. Really quickly, the way that technology is playing into the options markets is you're seeing more and more little tiny trades. That's what these two lines are at the top here. So, and this is really recent, okay? So we're talking about, basically since the beginning of 2020, which was the beginning of COVID, the amount of trades that are smaller than 10 contracts, okay, which is this blue line here, basically went from under 2 million contracts a day up to 4 or 5 million contracts a day. That's the Robinhood traders. Those are the only people that come in trading single contract trades. So, Brian, if you want me to speed up or skip stuff, just yell. Another way to look at it is the average execution size in the entire market has just been trending down as things have become more automated and small trades have become more popular, more people have gotten involved. So you see the average order size go from almost 20 to 6 currently.
But you still have the large institutional companies still doing their regular run, right?
You still have the large institutions doing what they tend to do. They're just getting kind of drowned out by the retail. And in fact, I don't know if I did in this one, but when you segment just look at, actually this one will tell you. So sizes over 5,000 contracts. These are massive trades, hundreds of millions of dollars in a single trade. Okay, the only firms that do that are not even hedge funds, just big banks and money managers. Maybe some of the biggest hedge funds. This is not market share. This is actual volume. So you can see as the volume exploded in 2020 and 2021, right? Remember I said we're like running at 9 billion contracts. The actual number of big trades dropped. So the little trades tripled and the big trade quantity dropped. So this work from home COVID kind of world has been incredibly good for retail activity. It has not really been very good for this big institutional kind of hedge fund activity. This one, I had a version of this that had a little guy in a Robinhood hat standing right here, but they made me take it away because now they work for an exchange. They're conservative. But Robinhood started options trading at the end of 2017. And so this is a chart of the volume of those teeny tiny trades, the one lots. And it goes from 500,000 a day, basically. So 500,000 individual trades that were one contract each to almost 3.5 million at the beginning of the year. This is kind of when the GameStop meme stuff was really getting nuts. Brian, this is related to what you were asking about. The clearing company that clears all the option flow releases daily stats on how many contracts were customer, how many contracts were firm, and how many contracts were market maker. Customer includes hedge funds and little tiny customers in general. Firm is banks. And you see this incredible kind of drop in the bank activity from like 25% to barely 11% as the volume has gone up. So this volume has exploded. The banks are not the ones doing it. It's customers. And on the other side of the customers, it's big market makers, liquidity providers. Technically, in reality, it's pretty much Citadel doing almost all of it. I think Citadel does about 25% of the daily options flow, a ton. Market quality, this is mostly to point out, because I know that you guys don't do this for a living, but the market quality is two things when you're trading, whether it's stock or an option, doesn't really matter, or any asset. You've got a bid offer, right? You got to pay something to buy it, and you got to hit a bid to sell it, and that difference between the bid and the offer is the spread. Okay, it's how a market maker or a dealer makes money. But as a customer, you can just think of it as like, geez, what if I change my mind and nothing's happened? If I pay $1 for something and then I change my mind and I got to sell it for 50 cents, that's a pretty horrific bid offer, right? You just lost 50% of your investment and you weren't even wrong. you just wanted to get back out. With options, you have a pretty narrow spread in most cases, and I'll show you a slide on kind of what things to stay away from. But when things go crazy, okay, this is that month where volatility exploded to 80, and the market sold off 30% before it pretty much turned around and bounced right back. The ability, the amount you got to pay to get in and get out of a position got pretty horrible. So it's something to know, because when you get into a trade and you make money, hopefully, and when it comes time to get out, if you're going to get screwed by this incredibly illiquid bid offer, it's something to keep in mind. And so mostly I want to show SPY is the most liquid product there is. It's the S&P 500 ETF. But March of last year, the available trading size got teeny tiny compared to normal, and the bid offer blew out. Concentration, just again, to just give you a flavor of the market, there's 5,000 things with options on them. Okay, pretty much every stock that you've heard of. It's not a penny stock. A whole bunch of ETFs and a bunch of indexes. Out of those 5,000, though, the top 200 are about 80%. So SPY and Tesla and Palantir and AMC and GameStop and Facebook, all this kind of stuff. So it's an incredibly concentrated market, although it's gotten better than it used to be. This is actually showing over the last 5 years. 5 years ago, 65% of the listings, okay, the stocks, had average daily volume below 200 contracts, which means it was basically not tradable. Today it's only 43%. So as technology has let more people into the market, and I will show you some stuff, the breadth of the market has improved because retail, really, who is driving the bus at this point, they like to trade all sorts of things, not just the big cap, really popular kind of hedge fundy stocks. This just shows you the explosion in listings. Okay, so like I said, we went from 4,000 to 5,000 stops a little while ago. We're over 5,000 now. The number of options that go with those 5,000 stocks has exploded as well. So that's, options have an expiration and a strike, and then there's a put and a call. The more stocks you list, the more options you're going to get. But the more the stocks move around, you get kind of more strikes get listed. And the industry's also added a lot of shorter terms options, because that's what people like to trade. They want to sell an option, watch it decay for a few days, and hopefully buy it back and make a little bit of money. That's a very popular strategy. I'll skip this one because it's kind of esoteric. Alternative expirations. This is just showing the growth in options. Used to be a third Friday of the month thing, meaning you could buy an option that expired on the third Friday of the month, next month, the month after that, out about 2 years. One of the innovations that came about, whatever this is, 9 years ago, was shorter terms. Like, I want an option that expires Friday, and the exchanges kind of started copying each other, and it spread. So now you see in something like Tesla, 65% of the daily volume is in these short-term weekly options, they're called. It's a little bit, when they listed them, I thought they were a disaster waiting to happen, because when you're managing risk, short-term options are very hairy, because they can go from 20 cents to $20 on you very quickly, versus like a 2-year option, which doesn't move as much. But they're incredibly popular. It's what customers like to trade. Like I said, kind of primarily because you can make a trade and either the option is going to decay to nothing pretty quick, or the leverage effect is very great. That's the end of those. But I got something else to show you. And I will give you, and so that's kind of what the market is that we have. I will show you what my system is, and kind of I'll give you the real basics on how it came about. So I worked on the floor, the picture you saw. I worked at a couple of different banks. And over my career, we went from the 4 exchanges to the, I think when I left Bank of America, which is the last bank I worked at in '05, there were probably 8 exchanges. And it was getting really hard to make sense of the activity and to help. My job was kind of to value options. And once you know what the value is, you can say, look, I don't really care what you want to do. This thing's worth $1. So I'm happy to pay 95 cents for it and sell it to you for $1.05. What do you want to do? You want to sell it to me or you want to buy it from me? And the whole point of being a market maker is you get some people come and sell it to you, you get other people come and buy it from you. They don't really need each other. So you get to buy it for 95 cents from him and sell it to her for $1.05 and kind of manage the risk in the interim time. And that's generally how it still works. But part of the process is, customers, hedge funds are giving orders to their brokers. And as a trader at a bank, the brokers, the salespeople they're called, would ask you things like, hey, what's going on in Microsoft today? And in the olden days, you used to be able to call somebody like down on the floor. Like I said, for a while, the first 25 years, Microsoft was only trading in San Francisco. So you'd call a broker in San Francisco on the floor of the exchange and say, hey, what's going on in there? And they, we saw Goldman came in and they bought 500 of these, and Schwab is a seller of this other option. And then you had something to tell the guy. Once the number of exchanges increased, and once the automation was increasing, it became kind of a joke in terms of like, well, I got to call 4 exchanges and then I got to go look at the data to try to figure out what to tell you. And in fact, the guy that sat next to me, when I was like, well, what are we supposed to say? Because as a market maker, you don't really care. You're like, look, I don't know what's going on, but it's worth $1. So what do you want to do? That doesn't help the process down to the customer. So the guy next to me is like, just make something up. And I did that for a while, I guess. And then what ended up happening, I got fired in 2005 or so. Basically because I wasn't making nearly as much money as the guy sitting next to me. Also, I was 40, 35, 37-ish, and the guy next to me was like 22. So he was cheaper and he was making more money. My style was a little bit more like, look, I just want to do lots of safe trades, and things were kind of evolving. But I left and talked to a programmer who I had worked with for a lot of years, who had also left around the same time. And, we were like, what do you want to do? I don't want to know. And we kind of said, well, this idea that we had that we never really developed within a bank was to make some tools to help people understand the activity, because it really was hard. Like I said, if somebody would ask you, hey, what's going on in Microsoft, you hit it up on your Bloomberg or something, and you didn't even have as much information as I'm showing you here. I don't know, hopefully this is not too small to see, but things would be kind of like this, like 500 of these options traded at $1.27. I don't know if there's a buyer or a seller. I don't really know much else. You basically had a way of seeing big trades and maybe seeing a little bit of aggregation in terms of what are the active options in Microsoft, but you didn't have any way to really kind of contextualize what the hell's going on. So we basically sat down and said, okay, well, it's not that hard. We knew the market, we knew how these things traded, and we knew how hard it was to come up with something intelligent to tell a customer, and even to interpret for your own understanding, right? If you, it's one thing to say it's worth $1, I'm 95 cents, $1.05, what do you want to do? It's another thing to become aware of the fact that somebody keeps paying $1.05 for those. They bought it over there and they bought it yesterday and they bought it from them. And so as much as a nice neutral two-way market is kind of the goal, it's not the reality that it used to be. Part of that is because the bid offer, and this is a good thing for customers like you guys, the bid offer used to be even wide, 95 to $1.05 is 10% wide. That's still actually a pretty hefty market, right? If you bought and sold a house and you had to pay a 10% cut, that's a hunk of change. It used to be wider. It used to be, used to trade in eighths, but let's say it was 80 cents at $1.20, and it didn't really matter if you knew what was going on or not, because you can still make some good money on an 80 cent at $1.20 type of spread. So we got together and basically just said, look, there's a need out there. I talked to a few people I had worked with, and they were like, yeah, they'd be useful. I don't know how much I'd pay for it, but it would help me do my job if there was something out there that would let me see what was happening and let me make sense of it. So we got a little WeWork type of space before there was WeWorks, and got basically, I guess, started, sketched out what we thought it was supposed to do, figured out where we were going to source the data from, and put together a system that, now has basically 15 years of evolution in it, but it's still a very simple system. In fact, the reason it looks like this, like a real simple single window, like, you type a command and you get back a menu, and you type a number and you get back a data set, is because the way most brokers and customers were talking to each other was instant messenger. And for the first, it was AOL Instant Messenger when we started, and it had been from probably around 2000. And so we figured out that, like, well, let's do it the same way people are already doing it. And a big advantage to that, and it wasn't quite like we figured out, okay, this is exactly what we need to do, but going in through Instant Messenger meant that it was just another chat talking to somebody, and they were already talking to a bunch of people, right? So it kind of snuck onto their desk and echoed the way that they already worked. And so what the system actually does is it sends alerts and it provides these recaps. We're not going to get any alerts because the market's closed, but they look exactly like the recaps look. So this is a trade taking place in IBM and the SEP 139 calls, and it gets pushed out to the users based on the kind of triggers that they want. So if they trade IBM, or their customer trades IBM, and they care about, say, trades that are decent sized, trades over, you can kind of set it up however you want, and it's very flexible. But in general, like our value that we added to the data, because the data was somewhat ubiquitous, right? You could see the data on Bloomberg or Reuters, which are kind of two big data platforms. But all it really basically showed you was 769 of these things traded at 70 cents. There was nothing else. And we started augmenting it with, like, well, some real simple rules, like, well, we believe if it trades on the offer, right? So this market was 64 at 69, then it's probably a buyer. And that's a simple rule. It's kind of common sense. And so now we're like, well, let's make the buyers green and the sellers red. So all of a sudden, really quickly, so there's two things happen here. One is it'll push out this trade based on the triggers that people set up. And two is you can look at it really quickly and be like, oh, look at that. Looks like a decent amount of option buyers, because I don't see any red. In fact, there's no sells in the top 10. Is the way that we serve up the data. You don't get what appears to be a seller until you're a little bit lower down. It's kind of simple, but people loved it. And all it really took, it took some technology, but it took kind of, first of all, it's like, well, let's kind of, buffer the bid offer, and then every time there's a trade, we'll be able to stick the bid offer next to it, and now you'll be able to see, and then you color code it. One of the things people kind of ended up loving was, remember I said there's 16 exchanges. So what happens a lot nowadays is the smarter traders or the more aggressive traders, they kind of shotgun their order to hit a whole bunch of exchanges at the same time, because these 16 exchanges, they all have these, these IBM calls. And so we bucket these trades in real time. It's the system took a couple of good developers to put together, but it wasn't really rocket science. But all of a sudden, we're giving somebody even more context, which is like, well, this is not a single trade of 69 contracts. It's actually made up of this whole blast that happened in 0.05 seconds. So it's a whole bunch of little orders, and then it finishes up with a 560 lot. But you can you get a feel for like, oh, wow. So now if you're talking to a customer, you'd be like, hey, listen, towards the end of the day, we saw a pretty chunky buyer of calls in IBM. I mean, stock was at 138. These options expire on Friday. Basically, they won't make any money unless IBM is at 139.70 in 5 days. So on Friday. And, you can quantify that the system will do calculations. So like you could put the amount of dollars on there if that's how you want to see trades. This is what it would look like. So this one comes by trade, not by sweep, but you can put it on the trade yourself. So, I mean, in this case, if it's 769.70 cents, it's around $210,000 that somebody just spent for a trade. And, and from then it was just iterations and innovations and listening to what customers would say. I mean, the customer said, hey, this is cool. I really want to see when are the next earnings. And we're like, oh, well, we can get that for you. And then all of a sudden, we can stick on next earnings, that kind of thing.
So they're getting an unfair advantage.
Well, using our system?
Yeah, because they're getting data that allows them to make decisions quicker.
It's not an unfair advantage. It's an informational edge, because the information's out there. You need to assemble it, like assembling it in real time and getting it in real time and making sense of it fast enough to do something is the advantage. So there's no information here that somebody couldn't piece together from the publicly available real-time activity, market data that comes out of the exchanges.
Yeah, but you're giving them an alert specifically.
We're giving them an alert, and we're doing like, there's complex orders and spreads in options are very popular. So like, one of the most common things people do is sell call and put spreads. Because if you sell a call or a put, you kind of have some unlimited risk. It takes a lot of margin. But if you sell a put spread, like here's something like this, the October 145.50 call spread, that's a trade where it can only be worth $5, okay? And it's only worth $5 if IBM gets up to 150. This is, so they get 43 cents for it. So it's kind of like listen, you're either gonna make 43 cents or you could lose up to $4.37 or 67 cents if IBM happens to go to 150, but maybe they already own IBM, so they're perfectly happy with that. Another thing we did was like say, well, let's put this together, because the rest of the systems didn't actually assemble that spread from these two trades because they don't come together. So
Hank, let's move off of options a little bit. So because we're a little bit over, I never did tell you the time. But before you close this, so what other applications have you thought of for this technology?
I mean, we're playing around with doing it for crypto. So, I mean, in a way, it's like we only know how to do one thing, which is take data and try to make sense of it for people, or try to help people make sense of it. And we were in business independent for almost 15 years, and we pretty much stuck with our market because we knew it the best and we felt like we could add the most value to it. We didn't go to Europe. We didn't go into commodities. But the concept of like, look, there's information I need to assemble, right? Like, like when earnings is not coming from the exchanges, it's coming from somewhere else. So,
you have to aggregate all that data.
Yeah, you have to aggregate it, but it's not. I mean, once you it's not impossible, and so like what we we can go into other assets. We could go into crypto, like we're playing around with. You can go into any asset that people trade, and nowadays with brokerage platforms like Robinhood, people are trading. I mean, geez, even like Nifties and things, right? So market transparency helps a trader and a broker. It's very important that it also helps a broker, because we make more of our money off of brokers than traders, because the brokers are kind of supposed to be the experts. And so when you hand them the right data, or you make it easy for them to get the right data, they'll pay you without it's not a hard sale. They're like, oh shit, this will make me look good to my customer Joe. And that's the end of it. You'll have that customer for life. We have users on the system we've had for the full 15 years. So it's I don't know. I guess it's more innovation and more evolution of things. And you can the patterns of trading. You can start to try to put some AI into it. What we're working on now is triggering based on AI. So like the way the system works is you can define kind of the characteristics of the trades that you care about or that you think are going to move the market, and they can be really complicated. Like this one is specifically looking for a certain kind of call buyer, but we want to use AI to actually set that up for people. So say, look, trust the system. It's a little bit like, cruise control that adapts. Like, I want the system to tell me the stuff that's significant with as much context as possible. I'll make the final decision if I'm going to buy or sell something, but let the machine do the smart stuff. Like, okay, the market's getting really busy. So if the market's really busy, I want to kind of pare back how much stuff I'm seeing, because, a $1 million trade has a certain amount of significance on a quiet day versus a busy day. So that kind of stuff we're working.
Well, and that's why I was wondering if all this AI and technologies continue to make drive the market up, because the computers are getting smarter and smarter and able to basically know when to sell and when to buy.
That's a tricky question. I think right now, what you have going on in the equity market is so many new participants coming in, because it's gotten so not just easy to access the market, right? They've taken away the brokerage costs, or they've kind of hidden them. So you get somebody who would not have traded an option or a stock now can say like, oh, I got $800. What can I do? And it's like, well, actually, you can open up a Robinhood account and you can trade all day long on $800. Are you going to make any money doing that? I don't know about that. But there is a dynamic that's going on that's really interesting, which is the more people that are coming into the market, they kind of have to buy stuff first, right? Like,
right. So that's driving the market up.
It drives the market up. I don't know whether it's driving it up for the most rational reason, because you get so far away from, kind of, you have this fork. You've got these people saying, like GameStop, right? This company doesn't really have, it has revenues that in any normal valuation would probably make it a $12 stock, right? Now, maybe they have some great ideas coming down, but everybody that does valuation for a living says this is nuts. There's nothing, if you want to go buy a car wash, you say to the guy, how much does this car wash make? And the owner says, oh, I make about $100,000 a year. He said, okay, I'll pay you $600,000. That's it. That's valuation. There's no, if the guy says, no, pay me $3 million, you're like, you're fucking crazy, because it's going to take me, 25 years to make my money back, and there's other investments that are more attractive. This retail,
This demand and the growth.
Demand,
Yeah, it's so easy. Anybody can do it.
It's so easy. I mean, you can buy partial shares, right? So like, even though you only have $800, if you want to put that $800 into Amazon, they'll buy you, a quarter of a share, whatever it works out to be. That's a good thing, I think, because it lets people in. The gambling effect where people are actually specifically going into options, and I'll show you one quick thing, and I know I don't want to use up your entire time. This the meme stock phenomena is bizarro, and like, so here's Ater. It's some stock that make consumer products, but it's not a very profitable company. It's been around for a while. This is the daily activity, so you can kind of see that, and if you go further back, it's a quiet stock. It had been at 18 bucks and it had kind of stumbled down to 3 or 4. And then all of a sudden, 2 weeks ago, it started to heat up, and heating up, I mean, people just started trading more and more and more. And this is 70,000 calls and 96,000 calls and 100,000 calls. And then today it was 300,000 calls. And the stock has gone from $4 to 12 bucks. I think it was at 16 for a little while today. The implied volatility, remember I said that kind of measure of how crazy it's going to be, has just continued to go up with it, which is weird because it shows you that people are just speculating. They're paying more for the options because they think the options can make them, a 500% return. And it's all coming from this kind of Wall Street bets crowd type of mob behavior, I guess. It's not, I wouldn't call it collusion, but it's close because you've got a bunch of people that can put some money behind it, and it doesn't take that much money to get everybody else kind of into this, snowball. And then you have the professional side of the market seeing what's going on, and then they'll just basically try to they get out of the way for one thing, right? They're not stupid. But on top of that, they're like, oh, this has a chance of being like GameStop. So GameStop went from whatever, 6 to 200. This thing could go from 3 to 100. It could. It doesn't make any sense. Doesn't make sense, but there's no reason it can't. So
it's a gamble. Yeah.
It's a gamble. So, and then just really quickly, our exit, which was not really well thought out when we started things, and that was a mistake that I made. We knew we wanted to build something good. We knew we could charge money for it and hopefully, be able to live off of it, which is what happened. But 10 years into it, we were like, okay, now we're in our 50s. How long are we going to do this?
Can we take a few questions?
Yeah, he's just talking about his exit, Bob, and then we'll get to that.
Yeah, it was basically, I certainly, my advice to myself would be, have the exit plan before you even get started, because, we found an exchange that really liked what we were doing. And then it was, it wasn't easy, but they basically said, look, we like what you have. We'd rather just take you than build it ourselves and try to copycat you. And, it took a year to kind of get it all lined up, but then they just bought us and they hired everybody. And now we're part of SIBO, and we have better resources, and we can broaden out, like I was saying, without kind of undertaking the expense of, like, you want to go to Europe to build a software thing and you're only US based, you got to hire a few people, you got to go figure it all out. We benefit from the kind of footprint that they have.
Yep, you've got the funding you didn't have before.
Yeah. So,
all right, Kristen, sorry, you've been waiting patiently.
Oh yeah, no worries. Thank you. So 2 questions. One, can you actually trade with this, or is it just giving you information? And then second question is, who are your competitors or major competitors?
Sure. So we stayed away from execution. So it is purely a data terminal. There were 2 reasons for it. First was we really didn't want to be a broker. That's a very expensive business to be in. It's very competitive. But the second reason was we knew that who we were going to sell this to was generally the banks, because that's where we had worked. That's where we knew the most people. we knew, the budget, of some, trading desk at Citibank, they could afford 10 grand a month to hook up their whole, to set up everybody. If we were aligned with a broker, or we were a broker, they wouldn't have done that. We would have had to basically make our money the way Robinhood makes their money, which certainly working for them. But 15 years ago, becoming a broker it's just very expensive. We started this, we bootstrapped it. We basically just worked for free for about a year. We had some revenue within about 6 months, and we never had to borrow any money or take in any capital. And then our biggest competitors, Bloomberg on the data side, and that's an institutional platform. On the retail-ish level, which is kind of a more, we always had a few retail users, but they probably make up about a third of our user base now. We competing with John Najarian, who's on TV, who talks about unusual options activity. There's a few dozen kind of market gurus who look at a trade, interpret it, recommend something to their clients. That's our competition. However, we actually sell the data to a bunch of them because we never really wanted to be in that business of recommending a trade. It's kind of sleazy, it's the reality is most customers that dive into options don't know what they're doing. They're gonna get hurt. So we just didn't want to do that. So
Oh, well, thank you. This has been really interesting.
okay, cool.
Yeah.
We have a question from Brigham. Sorry.
Yeah. Hey, thanks. Very interesting presentation. Thanks for sharing it with me. When you guys got bought, how many customers did you have, and what were those? Were they banks? Were they sort of hedge funds? And then what was the average contract size you had per customer in terms of dollars?
We had about 700 individual users. The average price was around $300 a month, so 200 grand a month or so in revenue. We never got big. That was nice. We liked the business that we had. That 700 customers were more or less 30 banks with kind of 25 people each. And then kind of a lower tier of another 25 shops. I think we probably had about 90 firms. And then we probably had, 100 individual people. And then we sell some feeds that can be a little bit more expensive. Those can be a few $1,000s a month. Like I said, we sell it to, some little website that wants to take our data and, do something more with it. It's funny that if you start something data related, you get into this situation where somebody says, yeah, I love it. I want your data. How much does it cost? And then you're like, well, what are you going to do with it? Because I don't want you to be my direct competition with my data. So that's been kind of interesting in trying to figure out we want, there's certain market segments or functionality we're just not going to bother doing. We don't like it, or we don't know it well enough. So, but that's a little kind of figuring out who you're cool with selling your data to and who you're not is sometimes a little bit tricky because you can basically sell to a competition. And
Henry, did you answer Kristen's question about who your competitors were?
Yeah, Bloomberg was the biggest. Somebody asked about Morningstar. Morningstar's a little bit more on fundamental. We're real-time data. Nobody really attempted to take the options dynamics, the flow, which is what we focused on, and do anything very similar with it. So it's funny. Bloomberg is still the platform most of the banks use, even though it's not super great. But Bloomberg wouldn't. It's too esoteric for Bloomberg. Bloomberg, keep in mind that Bloomberg's got 200,000 users paying $2,000 a month. Keep that. You can do the math. It's billions of dollars. But their users are stock and bond traders and foreign exchange traders and international. And so to kind of take what I guess our real success was, we addressed a niche. It was just big enough for us to be viable and do well. We really kind of killed it because we knew exactly what we were doing. We knew the customers, and customers helped us make it even better. And if you pick a good niche like that, you won't really have any competition because the big guys won't compete with you because it's too weird. Like I mean, a business that has 700 users, Bloomberg nobody cares about, but we did because we could live off it.
Like that. I have another question, but I want to open it up. Has anyone else got any other questions?
I have one.
Yes, Mike. Yeah.
You had mentioned that there is a opportunity for a low volume retail investor or trader to use your service. How much can you disclose what that would cost to subscribe for someone like myself?
Yeah, we I think on the webpage it says it's $350 even and that's what we charge the banks. We have a $150 version that provides most of the same information, so $150 a month. It doesn't have all the customization to it, but that customization can be overkill for kind of retail. Yeah, I mean, I'm not here to sell it, but if you trade options or you're trying to make sense of the options market, we're probably the only game in town. There's good. I mean, I was going to show, that there's, in terms of the tools, let me there's brokerage platforms. So Cboe owns something called LiveVol, which is another data terminal. It does some different things. But this is Thinkorswim, which is anybody can open up a brokerage account. You can do it with $50. I think you can open up a paper trading one for free. And the tools that you get nowadays for free are stupendous. Having done this for 30 years, we used to kind of kill ourselves to model volatility the way that you can now just pretty much get it for free. Robinhood doesn't do this, but Ater is this weird meme name. Just to be able to kind of look at the market this way and be like, okay, you can model the kinks and things will kind of jump out at you. The tools that are
complex. It's a very complex tool. That's the problem.
Yeah. So, but I mean, it's, and then there's other websites that, kind of mix data and training, I guess. And some of them are, you got to be really careful because there's some sleazy operators out there, but there's some that are perfectly good. They say, look, you know what, if you've got a $50,000 account and you're realistic and you want to make 15% with a little bit of risk or 30% with more risk, then they'll basically they have a community, they have coaching, that kind of stuff is out there too. So we didn't want to go into that because it's just a little bit too hands-on. Not everybody, it's hard to, you don't make an investment advice because it's like, what makes sense for me doesn't make sense for you. I don't like this kind of risk, but I like that kind of risk. It's hard to.
Umi, you have a question.
Oops. Yes, Yumi Sprague. I think the question that Mike asked, and your answer to that kind of answered my question. My question was going to be, is your tool more for larger financial institutions or individual investors? And basically you answered that it's for institutions, sounds like.
It's definitely designed for institutions. I mean, we have plenty of individual investors who know options and have traded options. Realistically, a third of them probably traded options, professionally somewhere before they found us and wanted our kind of data. So it's not a.
It's for the experienced investor.
We never put a ton of work into documentation because the people we were selling to were like, oh, of course, it's this and this is trade on the offer. I know that's a buyer. Okay, next. And so, we probably would have had more retail if we took the time to, document everything really, really down, low level, step by step. Here's what this data field means. Here's how it's calculated. Here's the interpretation. But it was too much work.
Got it. Okay, thank you.
Peter, your question's next.
Yeah, my question is about your data sources. When you were developing this, although you had a history in the industry, you were kind of an outsider at that very moment. Are your sources all public? Did you have to subscribe to them? How difficult was that?
They're all I mean, I didn't really know the data landscape when we started. I just knew it couldn't be that complicated. I made a business plan and did some research. And I'm glad I did, just because it kind of forces you to think things all the way through. But I think we just made, we just started. It was 2005, so Google was around. YouTube started the same week that we started. They did better. I don't think, I guess we probably just Googled and started making phone calls. So we have this platform that we're starting up. It's all, the exchange data's gotten a weird little issue where you got to pay the exchanges and file a whole bunch of paperwork with them to get approved to do it. And then other data pieces like earnings or dividends, you just search around and you'll find data providers. So it's all private in general. There's some places where there's a whole business of alternative data where people build scrapers and pull data. I saw at a conference a company that sells data that they pull out of the auto listings that are online, and they basically can come up with not real time, but almost used car price trends, because every car that's listed has to show the VIN number, and then you can actually map from the VIN number everything you need, not just the year, but the options on the car. So they can kind of normalize, like, okay, this Ford that has air conditioning versus this Ford that doesn't, they can actually kind of normalize everything. And they were selling an indicator to hedge funds that was completely sourced off of public information, scraping eBay Motors and stuff to see what things were selling for. And I was blown away. I'm like, this is a business, and it's totally a business. And it becomes a business that takes a lot of effort to do right, because you got to build the scrapers to go out and crawl the web and get the data. Then you got to normalize it. Then you got to clean it, and then you got to present it and find people to pay for it. So it's kind of wild, though.
Well, we're right at 6 o'clock. Any other questions for Henry? Henry, I really appreciate it. This was interesting. Still
Cool.
Not sure I understand what you do, but it was a good opportunity. So I really appreciate it. And I appreciate everyone else taking part and taking an hour before dinner. And I'll see you at the next TechBrew next month.
Thank you. Good night.
All right, you guys.
Thank you very much. Very interesting.
Snacks.
Thanks, Brian. Thanks, Henry.
Bye, guys.
Right.